Welcome to the deep dive. Today, we're diving deep into some financial concepts that are really important for anyone prepping for the CFA Level 1 exam. We've got all your study materials right here.
Yeah.
Yeah, all about quantitative methods, those building blocks of financial analysis, stuff like time value of money, descriptive statistics, probability, ready to unlock the secrets of quantitative finance.
Let's do it. These concepts are way more than just passing an exam, though. They're like the actual tools you'll use day to day to understand the markets, make better financial decisions.
All right, so let's kick things off with this idea of time value of money. I mean, I think everyone's heard that saying, a dollar today is worth more than a dollar tomorrow, but why is that such a big deal in finance?
Well, think about it this way. That saying gets to the heart of how we actually put a value on investments. I mean, if you have a dollar right now today, you can invest it and hopefully earn some kind of return.
Right.
But if you just wait till tomorrow, well, you've already missed out on that opportunity. Your sources even have this really specific example. They say you're giving up like a 5.26% return if you decide to spend 9,500 euro today instead of investing it.
So it's not even just losing money by not investing it. It's like you're losing the potential for that money to grow, and we're talking potentially exponential growth over time. That's kind of wild when you think about it.
Exactly. And that's where these interest rates come into play. There are a few different types to remember, but the one that matters most is that effective annual rate, or what we call the ER.
Yeah, I've definitely heard of that. But honestly, that formula always kind of scared me. Is there like an easy way to think about it that actually makes sense?
Sure. So the ER basically takes into account compounding. So you know how your return can actually end up being more than what the interest rate first seems to suggest? Like, your source mentions how an 8% interest rate that's compounded continuously actually gives you a better return than just a simple 8% per year.
So if you're comparing different investments, you can't just look at the interest rate they tell you. You got to dig deeper and think about the ER to really understand what you could potentially earn.
Exactly. Now, let's switch gears a little bit and talk about annuities. These are basically payments that happen over a period of time, things like your pension payments or maybe those mortgage installments. Your sources talk about two kinds: ordinary annuities, where the payments are at the end of each period, and then annuities due, where they're at the beginning.
So real world stuff, what kind of situations would you use annuities for? I'm having a little trouble seeing how this all fits together.
Okay, imagine you're trying to plan for your retirement. You want to know how much money you have to save now so that you can have a certain income every year once you retire. That's where figuring out the present value of an annuity comes in. They even give a really good example in your sources. Calculating the present value of a pension plan that has 30 payments, 1 million each payment, using a 5% discount rate. Turns out to be, get this, 15,372,451.03.
Whoa. Okay, that is definitely a real world example. Seeing how these concepts actually get used is super helpful. Okay, so we've covered time value of money, annuities. What's next on our deep dive adventure?
All right, let's move on to descriptive statistics, which is basically the art of understanding and describing all the data we use in finance. Kind of like when you build a house, you need a strong foundation first, right? It's like laying the groundwork.
That makes sense. But finance has so much data, where do we even start?
Well, your sources actually break down all the different types of data we use. First, you've got numerical data. That can be continuous, like stock prices always changing, or discrete, like how many shares you own. You can only have whole numbers of shares. Then there's categorical data, things like what sector a company's in, which is what we call nominal data because there's no order to it. Or you've got credit ratings, which are ordinal because they have a ranking, AAA down to D.
All right, so we've got our data all organized. What do we do to make sense of it all?
Well, there's this new thing called alternative data in finance, and it's made things a bit more challenging. It's all this unstructured data, stuff that doesn't fit into those neat rows and columns. Like, think about trying to analyze the feeling people have from news articles or what's trending on social media.
So it's not just about numbers anymore. It's like analyzing words and images, that kind of messy stuff. That sounds pretty complex.
It definitely is. But it's also a huge opportunity. I mean, imagine if you could figure out how the market feels just from reading the news or predict what stocks will do based on what people are talking about online. That's what unstructured data can do. It's a game changer for finance.
That's amazing. There really is always something new to learn about finance. That's what makes it so interesting. But let's get back to basics for a second. How do we even organize and present all this data so we can analyze it?
Well, your sources talk about tools like frequency distributions. They show how often certain values pop up in a data set. They break it down further into absolute frequency, relative frequency, even cumulative relative frequency. Each one gives you a different perspective on how the data is distributed.
So it's like taking a messy pile of clothes and sorting them by color and size. Makes it much easier to see what you have and find what you need.
Exactly. Your source even uses this example of like a portfolio's holdings. You can see how to organize it by the sector and the market cap, so you get a clearer picture
Yep.
of what's in the portfolio.
Yep.
And then there's the idea of bins and bin widths. When you're making a histogram, it's all about finding the right level of detail so you can visualize the data well.
So you got to find that balance between too much detail and not enough. Kind of like when you zoom in and out on a map, right? Too close and you miss the big picture, too far and you can't see the streets.
Perfect analogy. And speaking of visualization, your sources talk about all these cool techniques. Things like line charts, bar charts, scatter plots. They even mention heat maps. Each type of chart has its pros and cons. Choosing the right one makes a huge difference in getting your point across.
Yeah, I've seen a ton of misleading graphs, so using the right tool is super important. But besides just organizing and visualizing data, we need to actually be able to measure it and analyze it, right?
You got it. And that's where these measures of central tendency come in. It's like finding the heart of all that data. They give you an idea of the average or typical value in the whole data set.
So things like the mean, median, and mode, those are the big ones, right?
Yep. The mean, that's just your regular average. Then you've got the median, the middle value. When you put all the data in order, it doesn't get thrown off by those crazy outliers as much. And then there's the mode, the value that shows up the most. Really helpful when you want to know what happens most often. But it's not just those basic measures. Your sources also talk about weighted averages. Those are super important for things like figuring out your portfolio returns.
Ah, so instead of treating all the data the same, you give some data points more importance, right? Like using weights.
Exactly. Like in your source, they use the example of a portfolio that has investments in a bunch of different countries. The weights could be like how much of the portfolio is invested in each country.
Okay, now it's all starting to click. It's crazy how these simple ideas about averages can be used in such complicated ways in finance.
Yeah, it's all about building blocks. These basic ideas are the foundation for everything else we do in finance. But let's stick with measures of central tendency for a bit longer. There are a couple more in your sources that are worth looking at.
Okay, what else do we need to know about measures of central tendency?
There's one called the geometric mean that's really important for figuring out investment returns. It takes compounding into account, which can make a big difference when you're looking at performance over many years.
So if I'm trying to find the average return on an investment for like the last 5 years, I should use the geometric mean.
Exactly. It gives you a more accurate number than just a simple arithmetic mean because it factors in how the returns affect each other year after year. Oh, and there's also the harmonic mean. It might seem a bit weird, but it's actually really useful for things like dollar cost averaging, which is a common investment strategy.
It's like there's a different average for every situation.
Pretty much. And understanding the subtle differences between them, like the mathematical relationships your sources talk about, well, that's what separates the casual observer from a real investor.
Wow, I feel a lot more confident about averages now. What's next on our list?
So we've talked about those measures of central tendency. That gives you the middle of your data set. But now we're going to talk about measures of dispersion. They tell you how spread out your data is. And that's really important for figuring out risk in finance.
Okay, so if the central tendency is the heart of the data, is dispersion kind of like its pulse? Like it tells you how variable it is.
Exactly. We were
Right.
talking about things like the range, which is just the difference between the biggest and smallest values. And then there's mean absolute deviation, or MAD. That measures how far away, on average, data points are from the mean. But the most important one here is standard deviation.
Oh yeah, standard deviation. I know it's super important in finance. I just never really understood what it means.
Think of it as a measure of how volatile or risky something is. A high standard deviation means your data is all over the place. And in finance, that usually means more risk. It's really about how much those data points are different from the average.
So like if I'm looking at two investments and one has a way higher standard deviation, that probably means it's riskier.
Exactly. And it's important to remember the difference between population standard deviation and sample standard deviation. Your sources emphasize that. It matters when you're only looking at part of the data instead of the whole thing.
Right, and then there's that whole thing about degrees of freedom that comes up when you calculate the sample variance. It's kind of crazy how all these concepts and statistics are connected to each other.
It's like a big web of ideas.
Yeah.
But once you see how they're all related, it starts to make more sense.
I'm definitely seeing those connections now. This is pretty cool. So What other tools can we use to understand how spread out our data is?
Your sources talk about things called quantiles, like quartiles, quintiles, and percentiles. They split the data into equal parts so you can get a sense of how it's distributed. They also talk about Chebyshev's inequality, which helps you understand the chances of data points falling within a certain range.
So it's all about getting a grasp on how spread out the data is and how likely certain values are to pop up.
Exactly. And all of these ideas are leading us to a deeper understanding of probability, which is super important for dealing with the uncertainty of the financial world. But that's a conversation for another time.
This has been a pretty amazing journey through descriptive statistics. I already feel way more comfortable understanding and analyzing data.
Awesome. But remember, this is just the start. There's a whole universe of statistical ideas out there, and each one will give you new tools and insights to navigate the complexities of finance.
So we've laid all that groundwork with descriptive statistics. Now let's dive into something that's at the heart of dealing with uncertainty in finance. I'm talking about probability.
Yeah, probability. You can kind of think of it like the weather forecast for finance. I mean, we can't actually predict the future, right? But we can use probability to at least figure out how likely different outcomes are. And that's super important for making smart decisions.
Okay, that makes sense. But finance seems so, I don't know, unpredictable. Like there are endless possibilities. How do we even start applying probability to something that complex?
Well, your sources start off by introducing this idea of random variables and probability distributions. It's how we model and analyze all that uncertainty.
Right.
These variables, they can be discrete, like if you're flipping a coin and counting the heads, or they can be continuous, like the price of a stock. Theoretically, it can be any value, at least within a certain range.
So are we talking about like figuring out the chances of different outcomes, like whether a coin lands on heads or how a stock might perform in the future?
Exactly. And those probabilities, that's what those probability distributions capture. You've probably heard of the normal distribution, right? That bell-shaped curve. Seems like it's everywhere.
Oh yeah, the normal distribution. I've definitely heard of that. But why is it such a big deal in finance? What makes it so special?
Well, a lot of financial things, like stock returns, they tend to follow that normal distribution, at least roughly. So we can use it to make predictions and figure out how much risk is involved. Your sources talk about something called standardization, which lets you turn any normal distribution into a standard normal distribution. It's like having a common language so you can compare different normal distributions.
So we can use that standard normal distribution with all those z-scores and stuff to figure out the chances of specific things happening.
Exactly. Like, let's say we want to figure out how likely it is that a stock return will fall within a specific range. That's important for managing risk. Your sources even talk about this thing called shortfall risk. That's the risk of an investment not meeting a certain return target.
So with probability, we can figure out how likely different outcomes are and how to manage the risk that things might go wrong. That's pretty powerful.
For sure. But let's not forget about this other distribution, the log normal distribution. It's kind of like the normal distribution, but even more important for modeling asset prices.
Why is that? What makes the log normal distribution better for asset prices?
Well, for one thing, asset prices can't be negative, right? The log normal distribution takes that into account. It only allows for positive values. Plus, it reflects how asset prices tend to grow over time, which lines up with how markets work.
So while returns might be normally distributed, the prices themselves are better modeled using this log normal distribution. It's like picking the right tool for the job.
Exactly. And your sources make this connection between continuously compounded returns, which is something you see a lot in asset pricing models, and the log normal distribution. They're like two sides of the same coin, helping us understand how asset prices change.
Okay, this is starting to make a lot of sense now, but probability is just one piece of the puzzle, right? What about sampling and estimation? How do those fit into all of this?
Imagine you're trying to figure out the average return for all the stocks in the market. It'd be impossible to look at every single stock, right? That's where sampling comes in. You take a smaller group of data, a sample, and you use that to make guesses about the whole population.
So it's kind of like tasting a spoonful of soup to know what the whole pot tastes like. You're using a small part to understand the whole thing.
Exactly. Now, your sources talk about two types of samples. Probability samples, where you know the chances of any item in the population being picked, and non-probability samples, where it's not random. Probability samples are better because they're less biased and give you more reliable information about the whole population.
Okay, that makes sense. But even if you have a good sample, there's still going to be some error, right? You're not looking at everything.
That's true, and that's where this idea of sampling error comes in. It's basically the difference between what your sample tells you and what the real value for the whole population is. We use the standard error of the sample mean to measure that sampling error. It tells you how much you can expect your sample mean to be off from the real population mean.
So, like, if the standard error is small, that means your sample mean is probably pretty close to the real average for the whole population.
Exactly. And your sources give you formulas for calculating the standard error. Basically, it measures how spread out the sampling distribution of the mean is. Oh, but they also introduced this really cool technique called resampling.
Resampling, what is that?
It's basically using your computer to help you get better estimates. You draw samples from your original data sample over and over again to make a whole distribution of estimates. It's like running a bunch of simulations to see how much those estimates change and get a better idea of the real value for the whole population.
So instead of just using formulas, you're using your computer to kind of simulate the whole sampling process. That's pretty neat.
Yeah, and one of the most popular ways to do this is called bootstrapping. Your sources even have an example using stock returns. It's like pulling yourself up by your bootstraps. You're using the data to get better estimates.
This is all pretty impressive, but it seems like there's a lot that could go wrong. What are some of the things we need to watch out for when it comes to sampling and estimation?
Great question. Your sources warn about a few types of bias that can mess things up. There's data snooping bias, which happens when you overuse or misuse data, like testing different hypotheses on the same data over and over again until you find something that looks statistically significant.
So it's like you're playing with the data until you get the answer you want, instead of letting the data tell you what's really going on. That sounds risky.
It can be. And then there's sample selection bias, which happens when your sample isn't really representative of the whole population. Like, if you only surveyed investors at a fancy financial conference, your results wouldn't really reflect what the average investor thinks.
Right, that's like trying to figure out how tall everyone in a city is by only measuring basketball players. Your results would be way off.
Exactly. And last but not least, there's survivorship bias. That one's especially tricky in finance. It happens when you only look at investments that have done well and forget about all the ones that failed.
So it's like judging a diet based only on people who lost weight without considering all the people who gave up. You're not getting the whole picture.
Exactly. Your sources have some really good examples of how survivorship bias can make you think returns were better in the past and lead to bad investment decisions.
Okay, so all of this is super important to remember. It's not as simple as it seems. There's a lot more to sampling and estimation than I thought.
True, but if you're aware of these biases and use good statistical techniques, you can minimize their impact and make better choices.
Wow, this deep dive is really showing me how complex it is to work with data and finance. But knowing about these pitfalls and how to avoid them definitely makes me feel more confident.
That's what it's all about, getting the knowledge and the tools to really understand financial analysis and make good decisions.
Well said. So before we wrap up this section on sampling and estimation, is there anything else we should touch on that might be important for someone studying for the CFA Level 1 exam?
Let's talk about confidence intervals. It's a way to show how much uncertainty there is around your estimates. Instead of just having one number, like a sample mean, you create a range. And you can be confident that the real value for the whole population falls somewhere within that range.
So instead of just saying the average return is 6%, you're saying you're 95% sure it's somewhere between 5% and 7%. You're acknowledging that there might be some error.
Exactly. And your sources explain how to calculate those confidence intervals. You have to consider the sample size and how confident you want to be.
This is starting to feel like a really useful toolkit. We've gone from just describing data to actually making guesses about whole populations, and we're learning to be careful about all those potential biases.
That's the power of statistics.
Right.
It lets you go beyond simple descriptions and make conclusions about the world based on what the data is telling you.
I'm excited to see where we go next. But before we jump into that, maybe we should take a quick break. We'll be back soon to explore hypothesis testing and how it plays a crucial role in financial analysis.
Sounds good. Stay tuned. We're just getting started.
Welcome back to the deep dive. We've covered a ton of ground already, descriptive statistics, probability, And now we're going to tackle something that's really key for making smart decisions in finance, data-driven decisions, and that's hypothesis testing.
It's kind of like being a detective, but for finance. You start with an idea, a claim, your hypothesis, and then you use data to see if it holds up. It's like putting those beliefs to the test.
So it's not enough to just have a feeling about something. You need to back up your ideas with evidence, see if the data supports or refutes what you think.
Exactly. And your sources, they break down the whole process of hypothesis testing into these steps. The first thing you do is create this null hypothesis, which is what you're actually trying to disprove, and then the alternative hypothesis, which is what you're kind of hoping to find support for.
So the null hypothesis is like the bad guy, right? Innocent until proven guilty. You assume it's true until the data proves you wrong.
That's a great way to think about it. And then you choose the right kind of test statistic depending on what kind of data you have and the question you're trying to answer. Your sources mention all sorts of tests: z-test, t-test, z-square, f-test. It's a lot.
Sounds like you need a whole toolkit with different tools for different jobs.
Yep. Got to use the right tool for the job. And then there's this thing called the p-value you calculate. It basically tells you how likely it is that you'd see the data you have if that null hypothesis was actually true. If that p-value is below a certain level, you reject the null hypothesis and go with the alternative.
So it's about weighing the evidence and seeing if it's strong enough to change your mind about that initial assumption. But I remember reading about these type I and 2 errors. What are those again?
Yeah, those are the risks you run of making the wrong decision, which can happen. Type I is like when you convict an innocent person. You reject the null when it was true all along. And a type 2 error, that's like letting a guilty person go free. You don't reject the null hypothesis, even though it's wrong.
So even with all this data and all these fancy techniques, there's still a chance you could make a mistake.
That's right. And it's this balancing act, trying to minimize the chances of making both kinds of errors. Your sources talk about how important it is to choose the right significance level depending on what you're working on.
Okay, that makes sense. Can we maybe go through an example of how all this works, with real numbers? I'm especially interested in how you test hypotheses about means.
Sure thing. Imagine you think the average monthly return for a certain mutual fund is actually higher than what they're saying in their brochures. That would be your alternative hypothesis. The null hypothesis would be that it's actually equal to or less than what they're advertising.
So you're putting their claims to the test.
Exactly. And your sources, they have this whole step-by-step example of using a t-test to test that hypothesis. Assuming you don't know the variance of the whole population and your sample size is kind of small, they show you how to do the calculations, find the critical value, and what the results mean.
Seeing it all play out with a real example is really helpful. But what if you're not just looking at one population, but you're comparing the averages of 2 different groups?
Good question. That's where those tests for differences between means come in. Your sources cover a couple of different scenarios. Like, if you can assume the populations are normally distributed and have the same variance, you probably use a t-test with independent samples. They even give you the formula to calculate that test statistic and remind you how important it is to pool the variances from both samples.
So you're kind of combining the information from both groups to get a better estimate of the variance.
Right. But what if your samples are dependent? Like you're comparing 2 different investment strategies over the exact same time period.
That's when you'd use a paired comparisons test, right? It takes that correlation between the samples into account. Your sources explain why that test is better when your samples are connected in some way.
Exactly. It seems like there's a test for just about everything. What about hypotheses that deal with variance? That's got to be super important in finance, especially when you're thinking about risk.
You're right on the money. And testing hypotheses about variance is just as important as means. Your sources say for a single population, you'd probably use a chi-square test. They give you the formula, but warn you that this test can be thrown off if your data doesn't meet the assumptions, especially that whole normality thing.
So you got to be careful about assuming your data is normally distributed. Now, what about if you're comparing the variances of 2 populations?
What do you use then?
That's when you use the f-test. It's basically a ratio of those sample variances. And something to keep in mind, your sources point out that both the chi-square and the f distributions, they're not symmetrical like the normal distribution, and they can't go below 0.
So different rules and assumptions for different distributions. It's crazy how much there is to learn about hypothesis testing.
Yeah, there's a lot to it. But don't get overwhelmed. The important thing is to understand the logic behind each test, and then pick the right one based on the question you're trying to answer, and what assumptions you can make about the data.
This deep dive has been seriously eye-opening. But before we wrap up hypothesis testing, I remember your sources mentioning these non-parametric tests. What are those all about?
Think of those as your backup plan when your data doesn't play nice with those regular parametric tests. They're not as strict about needing specific distributions. A lot of times they involve ranking the data or using signs instead of the actual values.
They're a bit more flexible, huh?
Right. They can be really useful in the right situation. But we'll save a deep dive on non-parametric tests for another day.
Sounds good to me. My head is spinning with all this new statistical stuff. Before we move on completely, though, I'm thinking about hypotheses related to correlation. It seems pretty important in finance, understanding how different assets move together.
You got it. Correlation is like fundamental to managing your portfolio and figuring out your risk. Testing hypotheses about it isn't really different from any other parameter. You can have two-sided or one-sided alternatives and use the sample correlation to test those hypotheses.
So, like, if you think two assets are positively correlated, that would be a one-sided alternative.
Exactly. And what test you use depends on what you're assuming about your data. Your sources mostly talk about this parametric test of correlation, the Pearson correlation. That one assumes normality.
Okay, but what if your data isn't normal? What do you do?
Well, there are non-parametric tests too, like the Spearman rank correlation, which doesn't need normality and isn't thrown off as much by those outliers. Your sources have a whole example of using that one to test hypotheses about how currency pairs are related.
This deep dive has been awesome. We've gone from just describing data to making estimates about entire populations to testing all sorts of hypotheses. It's amazing how it all fits together.
It's all about having that solid foundation in statistics. Then you can approach financial analysis in a more rigorous way, let the data guide you. And as you keep studying for the CFA, keep this in mind. These concepts aren't just about acing the exam, they're about really understanding how markets work and making smarter investment choices.
I feel way more prepared to tackle the CFA exam now and use all these concepts in the real world. This has been an amazing journey through quantitative methods.
Glad to hear it. And as you keep learning, don't be afraid to question assumptions. Think critically and never stop learning. Finance is always changing, and being curious will take you far.
Well said. Thanks for joining me for this deep dive. I've learned a ton from your expertise.
It's been my pleasure. And for everyone listening, keep exploring, keep practicing, and remember the big picture. Use the power of data to make better financial decisions.
That's the perfect way to wrap things up. Thanks for tuning in to the deep dive. Until next time, keep learning, keep exploring.